got the A team of DSP Mutual Fund with us today. We're calling it DSP 2.0, a mega reboot in place. So let's try and understand with the A team what's really going on with DSP Mutual Fund in its new avatar. We've got the three wise men sitting in their brand new t-shirts, the brand new logo which has been launched as of just last week. So joining me today, Kalpen Parekh, President at DSP Mutual Fund. We've got Vinit Sambre, Head-equities Fund, and Pankaj Sharma, the CIO. Kalpen, have to start off with you first. Why this breakup of a decade-long marriage? After 10 years, you really don't think of a divorce. But why the split from Blackrock?
So it's not a divorce or a breakup. It's a very amicable, friendly parting. Okay. And primarily because, see, DSP as such is a 152-year-old name in the country in financial markets. It is amongst one of the founding members of the Bombay Stock Exchange. 20 years back when the fund house was set up, 21 years back, its first decade was partnership with Merrill Lynch, and then sometime in 2007-8 when Merrill Lynch was acquired, Blackrock stepped in. So it was a very fruitful 10-year journey. Over the last couple of years, as Blackrock also globally has become a very large-scale, largest asset manager on earth. They world over in various countries run their entire business in an integrated manner. So they are largely either 100% owned by Blackrock or a dominant partner. So for the last few years, they've been expressing their interest that they wanted to increase the stake. It was a 60-40 JV, 60 with DSP and 40 with Blackrock. From a global integration point of view, their keenness to increase the stake was evident in the last few years. Last year in November, they again reiterated that we would like to increase our stake to 100. When our other shareholder DSP said that no, we wish to continue in this business because it's a 15-decade-old brand and huge legacy, culture, relevance in the Indian market space. Blackrock even respected that to say that okay, let us be a majority where we'll be 70 and you remain at 30. But I think the Indian shareholder was very keen to retain majority. And then both of them very amicably, in a very friendly way, recognized that the DSP name is more relevant in India. So they offered to DSP the option to buy out Blackrock. And that's how we went ahead.
Could there be new partners in fray, or is DSP good with going solo?
No plans of looking at other partners because as such Blackrock was a great partner. And in a lighter way, they've also given this open offer that if you wish to look back for a partner, we are very much come to us first.
It's a different time now, agreed that that shift in behavioral pattern has happened. That SIPs and mutual funds and equities is the way to go. But if you look at the screen right now, you've got rupee at 72, you've got crude back at almost 80 levels. Small caps has dwindled. I mean, you've got to pinch yourself and see the screen and say, what happened here? 2017 was a dream run, but if I just look at the 2018 returns, you're down 15 to 20% on an average, and leave alone how individual stocks have performed. Do you sense that this bipolar nature of the market is here to stay, where large caps are at an all-time high, but it's nowhere close for mid and small caps?
So, as far as the markets are concerned, I think the behavior of the markets is not going to change. Just because the last few years we had a linear run, and more particularly in the small and mid caps, that doesn't mean that this is going to go on, the party is going to go on for a long period of time. So what gives us confidence over a longer term is the overall growth prospects of the country, the growth prospects of the corporate India. And hence, we have a lot of faith and confidence in the equity as an asset class and their ability to keep delivering the returns over a long period of time. But surely, as I said, the short-term macroeconomic picture, short-term global volatility is going to have its own bearing on our markets as such. Today, the most important issue which we are grappling with is this whole yield comparison between the fixed income and equities. So, if I were to look at the equities yield, which is inverse of price to earnings ratio, the equities yield is about 5% whereas you have fixed income which has gone up to 8%, which means the attractiveness of the fixed income paper is much better right now, which in a way leads to some shift of the asset category from equities to fixed income.
Pankaj, just taking a leaf out of what Vinit said, and considering you're the fixed income guy, you understand this a lot better than any of us perhaps. It's time now to move money out of equity and put it into fixed income, because just like he mentioned, the macro dynamics in the landscape in which we are right now is very tentative and very uncertain. No one knows what's going to happen to crude, rupee, or for that matter, its impact on CAD.
So there is always time to invest in fixed income. Not only this time, but because most of us we earn, we try to create wealth, we will be putting first money into the fixed income products and maybe allocating to other asset classes as well. So, what you need to look at right now, market is going through some kind of a fear that every day external market factors are driving what is happening in India, and especially in the bond market. So, rupee depreciates, crude oil price goes up, dollar strengthens, all of these variables have much higher correlation to the bond yields right now than what we have seen in the past. And that is the reason why, because there is concern about current account deficit, as you rightly mentioned. $18 billion last number was not very comforting, and India currency has also depreciated almost 11% so far this year. And but market is going through something called getting worried about something called fear, and I think that is a good time actually to invest, whether it is equity or fixed income, whenever there is fear here there. Most Indian bond market should be, and in the past has been, controlled by the Indian investor, because 95% plus held by the Indians only. I think we are going through a phase where there is concern about some fiscal deficit, whether it will be met, current account deficit, but I think market will consolidate over a period of time. And if you are looking at products to invest, look at products which gives you visibility of return, which gives you liquidity, which gives you lower volatility. So, we are telling people, look at products which have let us say maturity profile closer to March 2019, or a rundown maturity profile of 3.5 years, or a short term funds which are 1 to 3 years kind of a modified duration. Anyway, to achieve tax efficiency, you should be having a 3-year plus investment horizon. Do not just look at back for last 6 months or 1 year and try to evaluate a fixed income investment, because this is, fixed income is like the foundation of your entire wealth portfolio. On top of it, you have bells and whistles in the form of equities, alternative investment funds and everything else. This is something that you would like to keep safe, secure and liquid. So, you have different options, and I think these 3 options are right now appear much more appealing as compared to the others.
Kalpen, it's that the tactical call, that if you're looking at those 10-15 average kind of returns, you've got to stretch your time horizon, because the next 1 year is going to be volatile. You've got crude, you've got currency. To top it all, you've got the impending 2019 elections. And you know, any government, not just this one, typically tends to get a little more pro-populist. There will be those measures. They will weigh down on your CAD.
So, see, the approach I have learned over 2 decades of being a bad investor first and then becoming a slightly more rational investor is in a country like India with so many states, every 2 years there will be a state election and a central election every 5 years. Over time, I have seen investors, good investors, see through these events. And you know, one important comment I want to make you know, viewers understand is investing should not be around events, but how much of those events are in the price. So, no doubt because these events and headwinds are there, hence we are getting bond yields at 8 and 9%. The same bond yields were 6 and 7% 2 years back. So, today if a bank were to put a hoarding saying that, you know, FD rates gone up to 9%, people will start queuing up. The same is happening in the bond market right now. So, the benefit of a debt mutual fund is giving you straight away a tax efficient way of investing in the same category, number one. Number two, you know, a 1 year outlook at any point in time is always random. You know, even if I were to say that fixed income will give you 6 or 7%, but rates could still go up further or go down. So, I would always say that you know, you need minimum 3 to 5 years for fixed income as a time horizon. Anything less than 3 years should go into products which have no view, where whatever happens to the world, these products do not have a view, which is your money market funds or liquid funds and debt funds and stuff like that. But anywhere there is an expression of view, which is in bond funds or equity funds, the horizons have to be longer, and more so today, particularly in equity, because for you know, a lot of good news we have been awaiting for the last 4 or 5 years now, all of it is getting discounted at 25 and 30 times valuation. If you look back at the last 25-30 years of history of our markets, these valuations are not valuations from which you make tons of money. So, time horizons will have to get extended from where we are right now. And what do I do, for example? This dilemma will remain every month when we have our salaries. Where do you allocate? So, because headlines and data points keep changing. In this cycle, something very beautiful has happened in the fund industry, which has not got highlighted, is emergence of asset allocation funds. I'm very happy that in the last 2-3 years, a lot of money has gone into asset allocation funds, where they automatically reallocate between debt and equity depending on what is more attractive. So, for example, so we call it dynamic asset allocation funds. As of today, bond yields at 8 to 9%, equity yields at 3 to 4%. The portfolio is overweight fixed income. So much so that currently the equity exposure is only 10 and fixed income exposure is roughly 90 between fixed income arbitrage put together. It can flip over if equities become very cheap and bond yields come down. The 10% of equity can go to 20, 30, 40, all the way up to 90. I think all of us are confused that the markets are continuously surprising us. What is surprising us is these type of earnings getting these type of valuations. But why is that happening? Because there's huge amount of inflow, which is unprecedented. Last 2 years, the inflow into equity funds is higher than the inflow we've received since the beginning of the industry. So, we are seeing a lot of new things and that is getting reflected in prices. But these are cycles. Cycles change. So, as investors, we always, or as money managers, we try to, work hard to convey to investors that these are cycles. 2017 was a happy year. Prices kept on going up. Not that we could forecast it at the beginning.
Tip in the lift worked.
Yeah, it worked. This is the other side of it. My learning always has been that respect at what price are you buying, the good or bad news. So for fixed income, the news is looking bad, but the price is becoming rewarding.
Pankaj, would you agree with that?
Yeah.
Absolutely.
I think if you have a very high quality portfolio today, predominantly AAA, 80% plus AAA, where the modified duration closer to 2.5 years, portfolio item is almost 9% plus. So these are very high if you look at, and where your overnight rate is 6.5. So 2.5, 250 basis points kind of a spread that you are getting, extra carry that you are getting, it's very, very rich. But people right now are worried because they see rupee 72, they say, okay, let's wait. Maybe everything's, all the worst is not over. But I think there is a limit to which rates can go up in India. The biggest borrower in this country is the government of India.
And one more observation I'll make is that, we get good prices when news is bad. When news is very good, prices are not very good. So 2013 again, when rupee had hit 70, everything was gloomy. 10-year bond yield had crossed 9%. Overnight rates were spiked up to almost 10%. So whoever took advantage of that panic, opportunity for the next 3 years almost made, closer to 9-10% sort of returns, even in shorter tenor products, because you got very high rates. So both need to be calibrated. Doesn't mean that tomorrow the news can't get worse. I think if the meltdown in currency continues, there can be still more panic. But these are good levels to start building.
You're the equities guy. Is right now the right time when it comes to small and mid caps? The news is bad. There's been sheer amount of underperformance. Should one start deploying in, or would you say it's still notoriously dangerous? Stick to large caps. That's where you'll get stability.
So to start off, let me tell you that we've also announced the opening of our small cap fund, which we had shut because of hyper valuations, massive inflows, less opportunities in that category because of the hyper valuation. So recently we have took a decision to open the fund, and the trigger point is basically the price correction which we are seeing starting this year. Is this correction over? Are we sort of indicating that things are going to look good? No, that is not what we are hinting at. What we are hinting is that...
Oh, that's not? You don't believe that there is a...
So what we are trying to indicate is that the price points are becoming reasonable now. This is a healthy correction. It was in a way required also because things were going quite crazy in terms of the valuations. Will things change on the positive side from here? I don't think so in terms of the price point. They are not very attractive yet. I expect the volatility to continue, but we won't be ever able to we won't be ever be able to get the lowest point in the market, and hence what we are saying is that if the volatility were to continue, we should start now where some valuations are looking slightly more sensible. If volatility continues, if the stock keeps going down, for us it's an opportunity to keep buying. So the indication for investors is that for them also they should start looking at it at this category in a staggered fashion. 1 year may remain volatile, the prices may look low, but the value of the business will not change as much. Just to quote an example, if we have these major calamities taking place, we had this Kerala flood, we kept talking about what kind of impact will that have on the companies, and definitely many companies, the results will show up now this quarter where they will have the bearing of that. But remember, after this flood is over, after the whole things normalizes, there will be a recovery as well. People are going to build their house back, people are going to build their the whole whatever they lost. So the whole rebuilding exercise itself is going to create a lot of demand. We have also opened a fund on a SIP basis.
Vinit, I mean, alpha gains are made when you've got the price as well as growth right. Where is it that you're finding that kind of opportunity? Many who we talk to believe that corporate banks is it. And amongst corporate banks, where you're now finally beginning to see some yellow weeds or green shoots emerging, there is some clarity on what the top level structure is going to be like. And it seems like even the NPA cycle is now finally turning. Would you believe that's the space to bet on, or any other?
See, as a house, we have been more positive on the private sector retail oriented banks till now, but incrementally we have started looking at the corporate banks as well within the private sector and some of the PSU names. And like you said, I think the idea is that as these problems start coming down for them, the whole NPA related issues, as those start scaling down, the credit cost element for them will come off significantly, if not this year, next year probably. And some of them are showing decent growths. The growth is also going to pick up as the economy grows. So it will definitely make a sense to look at some of these names. We in our funds have some allocation to that category of banks, and we hold a positive view on the corporate banks as well.
The other view which is emerging in the market is book your profits where you made money, and that's largely the consumption theme, right? Be it staples, be it discretionary. Are you also of the opinion that valuations have run up way too much, and perhaps a little bit of nibbling out of profits is something which is sensible?
I think in terms of the consumption theme, which is the consumer staples and consumer discretionary, the good side of the story is that the demand momentum is still very strong, and it is only improving. And we have both the rural and some bit of urban push taking place, and this is all linked to the the income levels growing, the rural economy doing well. So I think that part of the story should continue, which means the demand should continue to do good. But also remember, in the last 5 years, if I were to consider some of these categories within the consumer discretionary and the consumer staples, most of them have, let's say, grown at a CAGR of 15-17% in terms of their profitability in the last few years. But what has happened is that the PE valuation has gone up from 20-25 to 40-45 and 50-60 in some cases, which is a bit scary. So people are ready to pay a premium to visibility of growth. Pankaj alluded to the visibility aspect. So wherever today the visibility is higher, I think the valuations are going to remain high. This is also to do with massive money getting pumped into the equity.
Pankaj, if one had to crystal ball gaze, I know it's a tough time, you can't really tell what's going to happen, but if you look at the developed world, it's US equities which have outperformed. If you look at emerging markets, it's us. Even if you look at emerging market currencies as a cluster, we've weakened the least as opposed to some of the others like Russia, Turkey, what have you. Do you sense that there could be some contagion effect which will sweep all of us in the same tide?
Yeah, fear is there, but I think if you are someone, a foreign investor sitting outside India, if he looks at the macro fundamentals of India from an equity investor, he can't get anything better than India anywhere else. Okay, a country which which used to be plagued with very high inflation in the past in double digits has been able to bring it down. Yes, we have one problem, current account deficit. I think, but market will, this exchange rate behavior will hopefully bring down our imports and get this in check. And it's not the first time this kind of volatility in the rupee has seen. Whenever this number exceeds $15 billion a year, a month, this one current account deficit, you find that the rupee is under pressure. But if I am a foreign investor, a lot of people would be saying, is it a good time to look into India for investments? Yes, this phase is there. Maybe people would like to wait out next 3 to 6 months. And that's the reason when I said, for Indian investors, where we can't, most of our savings would be in rupee denominated assets only. Fixed income is a good vehicle today. You look at products, by March 2019, lot of uncertainty will be out. You have products for that. You look at products 1 to 2 year current duration, which are today having fantastic carry. Look at those products, or rundown products that you have.
Kalpen, this is the equity and fixed income side of it. But now that DSP as well is going in for a mega reboot, we're calling the show DSP 2.0. Tell me, what is this new version going to be all about?
Of course, the name has changed and become a shorter name. On top
Cooler
of
t-shirts.
Cooler t-shirts, nice colors. I think we want to continue the same emphasis on discipline, being rational, being methodical about what we do, and keep guiding investors with authenticity and honesty. What are the right investment opportunities? We'll never shy away from saying that these things don't make sense or they make sense. So those things will not change. I want to reinforce that DSP 2 continues and carries forward the legacy of DSP 1 as well in terms of values. I think the group has always kept one principle, which our chairman keeps repeating almost every day when I meet him, that reputation first, investor interest first. So we want to build upon that. Like I gave you an example, last year our most popular fund, which was called the micro cap fund, now it's called small cap. At the peak of frenzy, it was 65% of our daily flows, and we said no, that this is not making sense right now. We were a bit ahead of time because the next 1 year it continued to rally. Many investors were upset that why are you not taking money, we'll go and give money to some other funds. But we held on to that patience, and even now we are opening it only through SIP. So I think what we want to build up further on is great investor experience. We want to be digital, we want to give good experience and bring scale. We want to build good partnerships with our advisors through whom we reach out to millions of customers, and we want to leverage, see the fact that with Blackrock we had the international market also access through them, but now we will be putting in place a solid blueprint to capture that space also. But from an Indian landscape point of view, our clear focus is carry our product range and build up on our relevance. Relevance to us is what is our market share and how valuable, profitable the company is. These are the two big drivers. We have, not many people would know, but we have been pioneers in some product categories. Like we have a huge range of international funds. So you mentioned that US markets have been the best performing asset class. And we have a fund, we have the largest US fund that we manage, where we feed into the best of companies outside. You want to play gold prices, so gold mining companies for last 10 years have gone nowhere. So we have a fund for that. We have a huge range of, we have India's first hedge fund through the mutual fund platform. So our whole idea is to carry forward the work we've done and become more scalable. And end of the day, if investors make money through us, they'll come back to us, and that is what we want to build. I think we look at this as an opportunity to be a pure play investment management firm. So our whole emphasis is if we create good, happy investors, our brand will become stronger, and people, it will resonate.
Goodwill is most important.
I think that hopefully that's the intent, and that is where even our new tagline is #Invest for Good. Invest for good means invest not just for long periods of time, because that's where real wealth happens. But invest for good means you can, once you achieve financial freedom, you can do whatever you want to in terms of your, life cycle. And there is a bigger purpose of money in life, and we would like to,
facilitate that.
Yeah, facilitate that journey. And I think it's a very energizing and enriching, opportunity and thought for us, and we are excited.
It sure is. And good luck from Team ET now for this brand new avatar of yours. Thank you all so much for taking the time.
Thanks.
Thanks.